The case study we will be looking at today has a corporate treasurer with 10 million US dollar exposures in 12 months. Worried that rates might go up in the next 12 months, just like they've shown in the last 2.5 months, our corporate treasurer is looking for a better hedge. Traditionally, he has used forwards to hedge his cash flows, and now is looking at the option market as an alternative way. The products that we'll be looking at are risk reversals, forward extras, and bonus forwards. All options, but at the same time, that will allow the treasurer to keep and maintain the same risk profile as the forwards that is used to use. We'll start by looking at the risk reversal, also known as a collar. We'll be looking at zero-cost risk reversal to start with. Risk reversals are effectively a combination of long call and short put. They create a synthetic region, a synthetic collar, in which the value is generated. The treasurer, by entering into a risk reversal, will benefit or will have the opportunity to benefit from appreciating underlying rates, and also will take on some additional risk in case rates will go down. The rates and the risk are known at the time this strategy is executed, therefore the risk profile will not be altered. Effectively, our European treasurer here is looking to buy a euro call and selling at the same time a euro put at different strikes. Selling European put will allow him to lower the cost of premium and eventually reach a zero-cost strategy. The European treasurer is buying at 135.84 and selling the European call at 129.45. This will allow him to achieve a zero-cost strategy. Our corporate treasurer has no intention of paying any premium for this strategy, hence is used to use forward contracts. Zero-cost strategies are a must. The next product we'll be looking at is a forward extra, a combination of a long euro call and a short euro put, and a knock-in barrier. The forward extra provides the hedger with a low-risk strategy that combines the protection that he has on a forward contract. In fact, the strikes on the call and the put are the same, and the flexibility of an option. We also added a knock-in barrier. Why we added a barrier? Because if by expiry the spot has not touched the trigger, has not touched the barrier, the hedger has the right but not the obligation to exchange at the strike. But if by expiry the spot has touched the trigger, the entire structure gets knocked in and the deal becomes a regular forward contract. In this case, we can see that we have provided an assured worst-case exchange rate for budgetary purposes for our treasurer, with the flexibility of participating in a favorable exchange rate move. The next product we'll be looking at is a bonus forward. With a bonus forward, the treasurer is entering into an option with a strike and a knockout trigger. If the trigger is hit, the option becomes a synthetic forward with a predefined forward rate that is different from the strike defined for the option. We are still maintaining and keeping the same risk profile that the treasury is willing to achieve, but we're just adding additional flexibility by playing with the option structures. Why would the treasurer enter in such a strategy? This strategy will let the treasurer enter into a position where he's fully hedged in the event of an adverse spot move, with the opportunity though to enjoy a limited participation in any favorable spot move. After having looked at risk reversals, forward extra and bonus forward, the logical step for our treasurer will be to compare these strategies against a traditional forward contract. The calculation will tell him exactly by how much he will be better off or worse off compared to a regular forward contract. In fact, by entering any of these structures, given that he has bought protection against rising underlying rates, he is already at prevailing market rates 18 grand better off than executing a forward contract. Additionally, the treasurer will want to compare and analyze the performance of any of these strategies. Backtesting is an analysis tool that will allow him to backtest the performance of the strategy compared to the relative spot rates prevailing within a time range. The risk reversal that we have backtested shows exactly what the performance compared to spot at any given point of time during the last 12 months has been, giving him a good proxy to assess the future performance of the strategies chosen. Compared to forwards, risk reversals, forward extra and bonus forward, represent effective hedges that allow corporate treasurers to have a low-risk strategy and be completely protected in an unfavorable rate move. In the next video, we'll be looking at other alternative option strategies, a bit more sophisticated, that enables treasurers to have an enhanced risk profile while achieving full protection.